All right, everyone. Welcome to another episode of the Kiss My Assets podcast. I'm Kyle Macdonald, your host, here with the CEO of Neighborhood Ventures, Jason Manwaring. How you doing today?
Hey, I'm doing well. We're here on a nice sunny morning in Phoenix, and a lot of exciting things happening, especially as the weather turns here. We get more people coming back to the valley. The schools have now started up, and it's an exciting time to be in Arizona.
Absolutely. That's the beauty of living in Arizona. The weather's always consistent. You always know what you're going to get. Some sun.
The sun is out, and now if our Diamondbacks can get in the playoffs, we'll all be happy.
Yes, absolutely. Absolutely. Well, we have some amazing topics to cover today. So the Kiss My Assets podcast, we do a deep dive into the economies for commercial real estate, ranging from macro to micro. We talk a lot about multifamily. And today, we're going to be covering the top 20 growing submarkets for new apartments since 2021. We'll also be covering the recent sales comps here in the Phoenix metro area, one of the largest multifamily markets in the entire United States. And then after that, we're going to dive into some macro economics, talking about multifamily cap rates and what those are looking like on a national basis. And so, Jameson, let's dive into it. So, talking about the top 20 growing submarkets for new apartments since 2021. This is quite an amazing list. We have metro areas from Phoenix to Austin to Dallas to Houston, Nashville, you name it. But what really stands out here is Phoenix and Dallas specifically have the most submarkets on this list out of 20. Phoenix having Avondale, Goodyear, West Glendale, Pinal County, so South Phoenix, Central Phoenix, and then Gilbert. Yeah, give me your high-level thoughts about this so far.
Yeah, we've been talking about this for a while because we operate just under 1,000 units in the Phoenix metro area. So we see the impact to additional supply directly into this market. And we've been talking about how it's been a soft market. It's difficult to raise rents. It's difficult to keep your occupancy high, and that's because we've had, for now 3 years running, and if you go back to this data in 2021, like 4 years, we're one of the top markets in the country for new supply of apartment buildings. In some ways, we've overbuilt, at least for the short term, because much of the building that was done is planned for the longer term. So if you're an apartment owner right now or an apartment investor, you really have to see these times through, because this is not a linear line that works perfectly where, okay, we have a lot of people moving to Arizona. We know that. Phoenix, it's about 10,000 people move here every month in the Phoenix metro area. So, to put that into context, over 100,000 people a year move here consistently in Maricopa County, and that's where these submarkets are. So that if you're a builder, you're a multifamily investor, multifamily builder, that's going to be a good market to go build in, and the trends and the outlook for growth are just as strong as they have been in the past with all the economic activity we have here. The other side of that is you get all of that supply, and it isn't linear. It happens in chunks.
Yeah.
And we've had a huge chunk here in the last 3 or 4 years of additional supply. And it's put pressure on apartment owners, especially those who have higher rate debt, who don't have permanent debt, more bridge debt. It's put pressure on operators who are not good operators if they outsource their property management. And the old saying is, when the tide goes out, you can see who's not wearing clothes. And in some ways, we're experiencing that now. Then this was after 15 years of really strong growth and resale. So that's what we've seen. That's kind of the landscape. In Dallas and in Austin, these are great markets to be in if you're a long-term investor. If you're short-sighted, then you're experiencing pain in these markets right now.
Yeah, absolutely. And before we move on, let's do some compare and contrast. So your company, Neighborhood Ventures, just recently closed on a new Flagstaff deal. Congratulations on that. I believe it's $1.4 million raise, quick close. And Flagstaff is having quite the opposite issue, right? And so as an investor, could you dive in a little bit more on what excites you about Phoenix and the growth here and the opportunities you see versus a market like Flagstaff that has the opposite problems where there's not a lot of supply, there's no new development, the occupancy across the table in Flagstaff is basically 100%. What excites you about seeing these numbers for Phoenix, and what opportunities are you seeing as an investor?
Yeah, it's a great question. It goes back to how real estate is very local. So if you're going to invest in real estate, you need to understand that local market, because 2 hours north of here, it's a completely different story in Flagstaff than in Phoenix. In Phoenix, what we're excited about is buying some of these assets where there's been operators who were not ready for all this new supply, who were not ready for these higher interest rates, because we're buying properties at a big discount, 45% discounts from 2-3 years ago. They're well located. They're in the Phoenix metro area. They're going to do great long term, but they're in some short term pain. That's what we're excited about in Phoenix. We bought 3 assets this year, all working directly with the banks. Actually, the operators were either they couldn't sell it for above their debt amount, so the banks had to participate with us. And we've bought 3 of those distressed assets this year, and we're going to be buying more. In Flagstaff, where we also have a couple of assets, the city has had a moratorium on the density of what they will build there. And there's been a lot of pushback from developers saying, hey, this is just going to continue to make the problem worse. Mm-hmm. So we're hoping that changes, because we'd like to develop some stuff in Flagstaff. But for now, rents continue to move up. Occupancy continues to be strong. Flagstaff is a highly desirable, kind of escape from the Valley of the Sun. You get a much cooler temperature. You're in the forest, and it's a very desirable place to live. And there's a big economy there. There's NAU. There's other companies there that support the economy. So we like the Flagstaff market, and it also provides some nice diversification from us, from Phoenix. But a very different market, and up there. It's difficult to find assets to buy. Yeah. So, and when they come up, most of the time they're overpriced. In this particular case, it was an owner who had owned the property 20 years. She was retiring, ready to sell it, and they didn't overprice it. They priced it well. In fact, they were probably a little under the market, which isn't a bad way to sell a building, because they got several offers, and we came in with the best team to come and buy it and execute on the purchase. And I think that's part of why they selected us. We gave them a full price offer and didn't try to over negotiate, because we knew that there was going to be a lot of interest, and so we bought it in the first few days that it was offered. And now we were able to go in, do a full renovation there. Mm-hmm. The property hasn't been renovated for since it was built in the 90s. Mm-hmm. We can invest that capital, and we know we're going to get it on the back end in rents and in the value of the property. So it's definitely the tale of 2 different stories right now between what we're seeing in Flagstaff, what we're seeing in Phoenix. And for us, we like both. It's just a different strategy.
Yeah, and for you investors out there, that was a beautiful compare and contrast of the opportunities that you can see in a market with a little bit more supply, a little bit more influx and growth like Phoenix, versus a market that doesn't have those factors. And so thanks for that, Jameson. You talked a little bit about sales. You talked a little bit about some of the properties you acquired. I know, so you bought Venture on Maryland this year, which was 78 units, Venture on 52nd, 71 units, and Venture on Coulter, 123 units, all here in the Phoenix metro. Yep. And we're going to dive into a little bit on we have some monthly sales comps review, August 2025, here in the Phoenix metro area from ABI Multifamily, one of the largest multifamily brokerages here in the Valley, localized. So total sales of 100 plus units this past August was $507 million. And then in the 10 to 99 unit range, there's $142 million. So total weighted averages came out to $649 million. And then diving into transaction volume. So there was 8 transactions for the 100 plus units and 11 for the 10 to 99 units. And this is my favorite metric. And I think for you investors out there, the most important metric to look at is the average price per unit. So for the 100 plus came out to about $289,212, and very close to the 10 to 99 unit range, $289,919.
Yeah, when I saw that, that doesn't happen that often. But the smaller mid-size apartments, the 10 to 100 units, came in the same price per unit as the large buildings. Typically, you see a higher price per unit for larger buildings, but we'll dig a bit into that. This month, that was pretty interesting. They came in almost right in line.
Yeah, absolutely. So, on this list, we have some significant properties that have sold. So the top selling property was called the Nines at Kierland in Kierland Commons area, which is, if you know Phoenix Metro, it's one of the nicest places to live in town. That sold for $419,000 per unit, so much higher than the average. And then if you go down to the last comp, you have some townhome units that sold for, you had some townhome units that sold for about $372,000 per unit. But on the low end for multifamily apartments itself, a project called Park Tower in Chandler, which sold for about $222,000 per unit. And so, you see a wide range, of course, product type, location type, you name it. Jameson, for you as an active investor here in the Phoenix Metro, what really sticks out to you about the range of these comps, and where are you seeing opportunity based on the current pricing?
Well, we're still well below normal transaction volume, but it's good to start seeing some more transactions. And really the reason why more transactions are happening is more buyers are coming to the table. Sellers have largely said, if we can sell at this, we'll do it. If not, we'll figure something out, unless they're in some sort of financial distress situation.
Yeah.
I'm really pleased. One of the projects on here is our Maryland Greens property that we purchased. And if you're watching this on YouTube, you'll be able to see this. But the average price per unit, as we mentioned, was $289, and we bought Maryland Greens at $137. And this is a really well-located property, but it was a distressed sale situation. That's why we got such a good deal on that. You also have in the smaller group this month some new builds, and that drove up the price. So, 16 units at $415 a unit. You had a couple of these almost kind of build-to-rent, Brower Hudson Crossing in Chandler, $534,000 a unit. It was 43 units, and that really helped drive up the price so that it was more of an equal. And we looked at a lot of these deals. The build-to-rent space in some of these, basically they're houses. In some cases, they are attached on one side of the building. In some cases, they're not. They're still selling at a good clip, $534,000 a unit. And so it's good to see some of those happening. And they may not be for us. We tend to want to buy low, where you make your money at the purchase. For us. So we want to take a more of a C property, turn it into a B property, or take a workforce housing building and take it up a few notches.
Can you talk a little bit more about that? So you mentioned one of the most important things, of course, is the acquisition price, right? Where you come in at the basis. So in a lot of multifamily operators or developers, we call that our lever. So where can we lever? When you're coming in, you're looking at a deal here in Phoenix, whether it's a distressed asset at a foreclosure or just an off-market deal. What besides the entry level point, what other levers and opportunities do you see to maximize and improve the value of these assets?
Yeah, our strategy has always been, since we started 8 years ago, we want to look for deals that have what we call hair. Mm-hmm. They have some hair on them. They're a little tricky because we have a lot of confidence we can figure them out. And that includes sometimes where you need to raise some capital and go do some significant improvements, whether that be kind of a regular turn and update the units, or a full full-blown renovation where you have to get into plumbing and electrical.
Yeah.
Right now, a big part of acquisitions is how are you going to finance the debt? Because capital isn't as free-flowing as it was a few years ago. You can still get capital if you're a good operator, but they're much more conservative in what they're going to borrow you, so you have to have a much clearer plan. And if you think rents are going to improve after you've done some renovations, you really need to support those with current comps of what is already happening.
Yes.
You can't really put some pie in the sky and say we're going to get to this level if it's not currently supported by the market, and that it just makes sense. So there's kind of more sanity today in how you look at it. But yeah, for us, the biggest lever is taking a project that we really believe in, having the expertise to work with the bank and the relationships to work with the bank. All the distressed assets that we've worked with, that we purchased this year, we've had to negotiate directly with the bank. So I think that when you have to take an asset, and if you're going to increase the value, you either have to improve the resale price, taking, like I said, a C asset to a Class B asset. Now a buyer can come in and buy a Class B who wouldn't normally buy a Class C. And that's how you're going to get your return.
Yeah. Well, I love seeing this data because, like you said, we're starting to see some more transaction volume hit. We're starting to see a little bit more liquidity from buyers, coming off the sidelines. Quick story, I got to meet the chief investment officer of Naveen, large asset manager in New York, about 2.5 years ago. And when I met her, one of the key things she told me was she had never seen this much dry powder within her clients and her investors' accounts in their history of Naveen. And so it's cool, just here in Phoenix and most likely nationally, but specifically here in Phoenix, we're seeing a little bit more uptick. And so
good deals, you can get them funded today if you're a good operator. And to your point, there's cash available. I mean, if I'm an investor today, I've seen the run up in the stock market, and I listened to CNBC this morning, and the big debate right now is there a bubble with AI? And Ken Griffin, who is a really well-respected investor, I believe it's Citadel's his company.
Yeah, hedge fund.
I had a few friends that worked there, and they're the smartest guys. And he's saying, the market's gone up so much. What's the opportunity now? And that's really where I come in at, for my own future and my own investment, my own growth of my portfolio is the risk-adjusted returns for real estate today, for multifamily today, compared to what they are in the stock market, I think are very compelling. We are in a lull right now. We are in a situation where you can buy assets at a discount to a few years ago in still good markets with good debt in place. That's an opportunity for me as an investor.
Yeah.
And the other things that I'm seeing, and I'll just point out, the AI trade is, it seems like that's played out a bit, and I wouldn't be surprised, and most investors wouldn't be surprised if you see a pretty strong pullback in the AI trade. That doesn't mean AI is not real. That doesn't mean that isn't a good long-term trade, but a lot of exuberance usually means that there's going to be some pullback at some point.
Yeah, and I think what you're hitting on for everyone listening is there's a turning point coming. And this article actually from Globe Street that we're going to cover signals that specifically for multifamily. Titled Multifamily Cap Rates Signal Turning Point for Investors. Multifamily cap rates appear to have stabilized and ending a 2-year cycle of steady increases and raising the prospect that the sector could be at the edge of an upswing. And this was a quote from the National Director of Capital Markets of CoStar, Chad Littell. That's quite a strong indicator for us as investors and those looking to deploy capital. What's your take on that?
Yeah, I think that it's true. Is we are now getting to that stabilization in any cycle There's periods of exuberance, and then there's a period of depression on the other side of the cycle, and then to get out of that, there's a period of kind of stability where things start to kind of work again.
Yeah.
And even in the transactions we've seen in the Phoenix market in August, and then with this data more nationally where cap rates are now appearing to stabilize, I think that that's indicating that we very well could be in that part of the cycle where now things start to improve a bit more fundamentally.
Yeah, and if I were a listener, I'd be thinking, well, if things are stabilizing, what's causing that stabilization, right? Because interest rates are still high, right?
But they're coming down.
They're coming down. The Federal Reserve did just have a 25 basis points rate cut, so that's optimistic.
And many people think that the Fed's getting into a interest rate reduction cycle.
Yeah.
So, we've had intentionally high interest rates to slow things down, and now we're out of that mode, and we should get into more of a neutral interest rate.
Yeah. And of course, there's always a strong correlation between interest rates and cap rates, which help derive the value of these assets. But Mr. Littell of CoStar, he argues actually more in favor of rent growth, and rent growth being the true driver of this stabilization we're seeing in the market. Could you talk a little bit more about that?
Yeah, the math behind these numbers.
Yeah.
A lot of people think that cap rates should just go the same direction as interest rates because 50-60% of most real estate projects have debt, and so that is the main driver. But I love this article that Peter came out with because it's a different way to think about how cap rates will move going forward. Mm-hmm. And we have had some cap rate increases. We've also had all this new supply that we talked about earlier, which has kept rents down. Mm. So as we see that new supply get absorbed, we see new supply slowing way down, even in these hot markets like Phoenix and Dallas. Now I think you'll start to see improvements in cap rates, which means they should go down. Yeah. And he points to that may be a better driver going forward of what cap rates do than just interest rates. Yeah,
absolutely. He argues that recent stabilization in cap rates coincides with rent increases bottoming out around 1%, with forecasts anticipating a lift back to 2.25% or 2.5% range over the coming 12 to 18 months. Yep. So that's going up 100 to 150 basis points on rent growth over the next 18 months. That's significant.
Yeah, and I think we will start seeing rent growth. Yeah. We have some pent up demand for rent growth. Landlords have had higher costs. Insurance costs have gone up. Maintenance costs have gone up. Rent growth has not gone up because rent growth is driven by economic factors. It's not driven by a landlord that has higher costs. Yeah. It's driven by what can the market accept. What will somebody pay to rent here versus another place? So because renters have had more options because of all the new supply in these high growth areas like Phoenix, there hasn't been rent growth. Yeah. So, but that supply is getting absorbed, and I look at the incomes of the folks who are moving into our building, and I can tell you they can afford higher rent. Mm-hmm. They may not afford being able to go buy a house today at these interest rates and these prices, but they can afford higher rent. And I think we're going to get rent growth in the next few years to get back to a more normal 3 to 5% growth, and I think we might see some years where it's much higher than that.